I looked it up recently and I haven't bought a stock in 11 months. 11 months? What have I been doing with my life? Well, paying off debt for my house, fair enough, but it's time to buy stocks again. And the stock that I'm buying is a stock that Sven Carlin said he thought could triple in price. Super investors like Buffett, Seth Klarman, and David Tepper own the stock. It's a stock whose business is taking advantage of generative AI, cloud computing, e-commerce, and many modern day growth trends. And maybe most importantly, it's a stock that is pretty reasonably priced. You might be able to guess what the stock is, but the stock is Amazon, and here's the 7 reasons why I'm buying it. By the way, I've included timestamps in the description below in case any of these sections do not interest you. But the first reason why I'm buying is their AWS business. Currently, 90% of the global IT spend is on-premise, aka businesses use their own computer IT infrastructure for their computing needs instead of the powerful systems of Amazon, Microsoft, or Google Cloud. This is important because it's saying that businesses are still stuck in the past. It's very inefficient and costly to build your whole computing system yourself and maintain it instead of just paying Amazon to use theirs, a small fee. It's like building a windmill in your back garden to get electricity to power your home instead of just paying an electric company a fee to get their electricity. It's not efficient. Cost, time, maintenance, everything. Amazon's management in their recent earnings call said that they expect this equation to flip, where businesses realize, hey, I don't need to pay millions to run everything on premise. I can just pay a small monthly fee and get access to a Fortune 500 infrastructure for pennies on the dollar. And when the equation does flip, the companies that offer the best cloud computing service will make a lot of money. And Amazon is at the top of this list currently. They're the largest cloud computing provider with AWS, beating Microsoft, Azure, and Google Cloud. They're still growing the fastest as well from a nominal perspective, and they were the first major company to get into cloud computing. They know this game as well as any company. And of course, with their culture, they focus on the customer first, and this has the potential to generate untold cash flow for them in the future. Generative AI is shaking up the world, and this is going to disrupt thousands of sectors. Just think of them. Customer support. Don't need it. AI can do it. Writing. Essays, copywriting, scripts. Think of the form, and there's a good chance AI can do it much better than almost any person with a single prompt. Even we're seeing recently, it's replacing background actors, and they're striking about it. I could give you 100 different examples from autonomous driving to whatever. AI is going to disrupt almost every industry, trillions and trillions of dollars, and this is why you listen to all of the earnings calls and the big companies, they cannot stop mentioning generative AI. Sadly, this does mean many people are going to lose their job. I hate to say it, but especially those at the bottom of the system because they won't be needed. But people who own companies that are in AI are going to profit massively. And this is where Amazon comes into play. They know as well as any company how big the likes of generative AI can get. So they're setting up their company in a way to profit from it. I'll quickly go over 7 different ways in which they've set up their business to make money from AI. And this is it probably won't be massive amounts in the near term, but in the future, the potential is huge. So they've developed Amazon Bedrock, which allows businesses to build generative AI applications on. And big companies are already adopting this. Adidas, Booking.com, Ray Dalio's Bridgewater. If you listen to the recent earnings call, it is growing very quickly, Amazon Bedrock. But they're also focusing on the other side of the equation. They've designed their own chips that customers can use to train AI. We all know there's a huge demand for chips. Just go look at NVIDIA. They basically power our modern day life, and they're also needed for AI. Amazon know this, and so they've designed their own chips that customers can use to train their AI. And what's beautiful about it is they deliver all of the silicon in-house, so they're not reliant on any outside forces, which is great because in the current modern day world, we never know what's going to happen in other countries. So this could be very profitable side to their business in the future. 3, don't forget about AWS. AWS offers cloud computing for the generative AI companies. So a lot of generative AI companies, they need AWS to operate. So with this, Amazon, they're not directly making AI products, but they are needed for the companies that are making the generative AI products. 4, they've put AI into Alexa, where the goal is to make it the world's best personal assistant. So who knows how effective this could be? You know, it might be a super personal assistant. 5th way they're profiting from AI was in 2017, Amazon launched SageMaker, which is their machine learning platform. Well, machine learning is kind of different to generative AI, but it's in the same sector. And SageMaker now has over 100,000 customers, which means the majority of machine learning happening in the cloud is happening on AWS. They use AI with their search to improve their search. And lastly, they're investing $100 million into a new generative AI innovation center, which $100 million sounds big, but in the grand scheme of things, it's not massive compared to how much Microsoft or Google invested. But the question is what they can generate from this center. How many billions of dollars of products they could generate. I'm not sure. And also, I just want to mention they have Amazon Titan, which is their version of ChatGPT and Google Bard. So they're certainly big in the AI space, and if you own Amazon, you will inherently profit as AI gets bigger in the modern day world. And of course, you want to be on the right side of the AI equation. Instead of losing your job, you become an owner in the technology and you make money from it. The third reason why I like Amazon is their traditional Amazon business is great. A lot of people like to think of all of the new things that Amazon are in, but don't forget about their traditional business model, which is beautiful and dominant. Amazon was the OG business to do online shopping, and they're still the biggest in the world. They got so many third-party providers. They're so quick with their shipping, and they, even in their recent earnings call, they said they've got shipping at the fastest they've ever had it. So as you can see, they're always thinking about the customer. How can we make our customer as satisfied as possible and get the products to them quickly? The fourth reason is they have a reasonable price right now. I'm going to talk a little bit more about the value of Amazon stock in the numbers section of the video, but just remember 4 years ago when 3 companies had reached $1 trillion market cap. Apple was the first to reach it in August 2018, Amazon was the second in September 2018, Microsoft, they were a bit behind, they got there in April 2019. Big achievements, but where are these 3 companies priced at today? Apple was priced at 2.6 trillion, Microsoft at 2.5 trillion, and then little old Amazon is at 1.3 trillion. So that's like half the price of the other 2. There's a reason why it's less pricey, and I'm going to talk about that soon. Fifth reason why I like Amazon is that it's just extremely customer focused. And it's probably why I like Amazon the most. They constantly think about the customer. How can they improve experience, cost, satisfaction? That's like their North Star with the business. This is something that Jeff Bezos has riddled throughout Amazon. You hear even the new CEOs of AWS and CEO of Amazon talking about customer, whether it's the cloud, the AI, the e-commerce, they just want to help the customer. Even if you read their recent earnings report, they had a whole section where they wrote about how they are obsessing over customer experience. And the beautiful thing is when you help your customer, you help others, customers want to buy from you. They want your business because you help them the most. And long term, this is how you make dollars. Yes, in the short term, you could raise prices and cut internal costs and make some short-term money. But to make the long-term big dollars, you focus on the customer. And that's why I'm bullish on Amazon over the long term. So the 6th and 7th reason why I like the stock is the numbers and the intrinsic value. So look at the numbers, look at the revenue. They know how to grow revenue. That's one thing Amazon, you can't mark Amazon down for. What's it, 2015, 8 years ago, revenue was 100 billion. Now, 500 billion. So they're growing revenue very well. Even just look over the past sort of 5 years, they're averaging 30%, 20%, 37% growth rates. So we can be conservative and let's say in the future, maybe they'll grow at around 20% in terms of revenue. So that's the reason I like them. They're growing revenue well, but even this is an interesting thing to note is look at their free cash flow. So trailing 12 months, they made 16 billion in free cash flow, but look at cash from operations. They made 70 billion. So why is there this big disparity between cash from operations and free cash flow? The reason is because they're investing so much money into capital, because they want to be very competitive over the next 10, 20 years and take that market share in AI and take that market share in cloud. And to do this, they need to invest a lot of money. So the free cash flow, the amount of money that they actually keep in cash, doesn't look that great. But you look at cash from operations and it looks amazing. So that just from operations, they're generating 70 billion in cash flow. And one thing that Wall Street do not like is when the free cash flow isn't good. The amount of money that they keep at the end of the day isn't good. The index funds algorithms, they don't like it. The Wall Street people don't like it. And that's one of the key reasons why the stock is down. And it's not as pricey as the likes of Microsoft or the likes of Apple. Even just think about it. Why was Meta stock down by so much a few years ago? Because the cash flow, the income wasn't good. And as soon as they started generating income again, well, the stock started to go up. Well, right now, Amazon aren't generating great free cash flow and Wall Street don't like it. But let's just think about intrinsic value. If we use the cash from operations, 71 billion, we use future growth rate of 20%, which is somewhat conservative since they were growing by 30%, whatever, in the past, and, do a normal 10 discount rate, 10-year forecast. Let's say, be conservative, 20 PE in 10 years' time, based on a future growth rate, that's pretty fair. Well, what could the potential intrinsic value of Amazon be? We press calculate. This could potentially be a $4 trillion stock if they stopped reinvesting all of this money into capital expenditure. But because they are investing so much money, the stock is only a $1.5 trillion stock, so it doesn't look as good. But, if they play things smartly, I can see why Sven Carlin said that this stock could triple in value and price. So let's just say this is a normal case scenario. This could be a $3 trillion stock. Let's just say, okay, be a bit more conservative. Let's say $50 billion in free cash flow. Still a $2.7 trillion stock. And this is why I like the company, because they're spending so much money on capital expenditure. Wall Street don't like this. But if you take that capital expenditure out of the calculation, it looks like a very attractive stock. Couple of other interesting things to note is they do have a lot of debt on their books, which I generally don't like. A lot of debt, debt to equity at 100%, but the return on equity is quite good, 20%, 28%. It's a good business, Amazon. This shows you that they're an effective business. But the debt I don't like, and you can see they do hold a lot in cash and short-term investments, but they also hold a lot in short-term debt and long-term debt and capital leases. So that's the one thing that I don't like about the financials. But overall, intrinsic value, pretty good.